Okay, folks. Get started. Reminder again, next Wednesday, next Monday, we have no class. Next Wednesday's class will be on Zoom, so. That's it. So we're going to talk about the alternative to historical risk. So, Gandharv, remind me again what's wrong with historical risk premiums and look backwards to estimate net risk premium.
Mean reversion that
What is your assuming mean reversion, which normally is not a bad thing, but what's wrong about assuming mean reversion time we're in with historical risk?
that we assume that there hasn't been a systematic change.
So in 1995, if we made the assumption of mean reversion, you were on much stronger ground, right? You could say we're a developed market, things revert back to the mean. The US was the most mean reverting economy and market in the history of economy and market during the 20th century. 2024, we're looking at a very different market. So mean reversion is working against you because it's not mean reversion as a problem, it's a structural shift. What else?
The problem with that arithmetic and geometric rules.
One is, it's subject to estimation choices, which plays a role because you're biased, right? So if you want to get a low risk premium, you can pick a number that reflects that. There's bias. You want to finish? If you pick a number, when you have an average, you also have a standard error, right?
Yeah.
Which is even if you trust the past, you think that no structural change, you have this issue of you get a range, and the range is a pretty wide one. So that's what led me on the search for, we need a better way of estimating that. So around the early 90s, as I said, I started thinking about this notion of forward-looking dynamic premiums borrowing from the bond market. So today, to show you the birthplace of that implied premium, I'm going to start with a very simple example. Okay? So let me pick on someone here. Shruti, you're going to be my lab expert. So I'm offering you an investment. Let's assume this investment is going to pay you $1 every year in perpetuity guaranteed. How much would you pay for that? Give me a number and we'll back out from it whether it's reasonable or not. $1 a year every year in perpetuity guaranteed. Well, in perpetuity, your successes, so there's an element of hopefulness in this question of the world will go on. Act like that's true. If you pay 100, what do you make each year? 1%. Is that enough for you? Right now, given the world, it's in US dollars. You see, you said based on nothing, but it's not, right? It's a risk-free investment, and right now the T-bond rate is about 4%. So if you want to earn 4%, how much do you pay for this? You pay about $25. You tell me what you pay, I back out from it a rate, and that number looks, so that's if it's risk-free. Let me move on. Hari, you're going to be my next guinea pig. So it's now going to be still $1 every year in perpetuity, but instead of being a guaranteed investment, it's going to be uncertain, and you can define uncertain as what it, as risky as the typical equity in this market. So now you're going to get $1 still. You know, you're going to be paid $25 for that investment, which is guaranteed. But let's have an easy question. Would you pay $25 for this investment? Okay. It's the same dollar. Why not?
So it's getting risky.
It's uncertain, right? So we know which direction you need to go. You need to go lower or higher. So give me a number. 10. If you give me 10, you told me what your implied equity risk premium is. Here's why. When you pay $10 for the investment, you make $1, you make 10%. Right now, the risk-free rate is 4%. The implied equity risk premium is 6%. That is at the heart of everything else. Is this icing on the cake. You tell me what you pay. You're already giving me by that number what you would like to earn as an. This is why you don't want to ask people what your equity risk premium. They can make up stuff. Look at what people pay, not what they say. So in the case of the index that you saw, you basically saw that play out when I took the S&P 500, which is what you paid. It's a little messy because it's not a dollar, it's basically cash flow, but it's the same principle. And just to show you why this is a dynamic number, right? I was teaching this class in February 2020, and I posed this question to people, and they came up with a judgment call 4%, 5%, 6%. And then, of course, February 14, COVID hits, we're all sent home. So 2 weeks later, when I was, when we were on Zoom because we couldn't get back together, I asked them the question. Remember, I asked you how much you would pay for that dollar with uncertainty? Would you pay the same amount? And it gave them a chance to reassess. What do you think they came back with as a number? Lower number or higher? They said there's more risk. I feel worried about those who will come back. They said, so the $10 I told you, I'd pay only $8. Ready, you can see what the equity risk premium did, right? 1/8 is 12.5%. The equity risk premium went from 6 to 8.5%. So when you have crisis, you should expect to see the equity risk premium change. So today I want to start with that and talk about how this plays out in the market, because it'll give you some insight into why we get crises. And how that plays out. So this is January 1st, 2020. I computed the equity risk premium for the S&P 500. And again, you can see the setup. What you paid for stocks, expected cash flow. You start with what you made in the last 12 months. And you do use projected growth rates from analysts. Could be wrong. There's a standard error there. And then after year 5, assuming the cash flows will grow at the same rate as the economy, and I use the risk-free rates in that box. So the equation, thought in purely math terms, that is the equation. I solve for the discount rate, or I let Excel solve for it because it's a messy equation to solve. So I use the solver function. I come up with an internal rate of return of 7.12%. People are feeling pretty good. The economy was doing well. Unemployment was low. There's nothing on the horizon that they saw that. And this is, I think, the time that crises hit, because when you don't expect it. Because this is actually the implied equity risk premium on a daily basis through 2020. So if you can look, the first 6 weeks of 2020 until about February 14, nothing's really happening. Same expected return, risk premium is not changing, around 4.5%. And then COVID hits. Terrifies people. If you look at the implied equity risk, remember this now is reflects. So as the index changes, as it drops, I'm recomputing the premium. And if you're not quite getting the mechanics of why as indices drop, premiums go up, think about bond prices and interest rates. So the price of a bond drops, the interest rate goes up, the same phenomenon is playing out here. The equity risk premium in the next 6 weeks, 45 days, between February 14th and March 23rd, the implied equity risk premium for the S&P 500 went from about 4 to 4.5% to almost 8%. If your risk premium goes from 4.5 to 8%, what's happening to stock prices? They're collapsing. That was the 36% drop in the S&P 500. And I've done this on every crisis that's happened in the last 15 years. I did it around the 2008 crisis, I did it during the Brexit elections. And you would see as a fear, the risk premiums can change a lot in short periods. On March 23rd, 2020, things looked really dark. And then something magical happened. And there was nothing you could point to. When people have struggled with it. What happened between March 23rd and 24th that changed the mood? I think it's a search that you will never be successful in because who knows what causes crowds to change their mind. The mood shifted. And what made 2020 such a unique crisis was how quickly the mood shifted. Because if you look at 6 months after the crisis, you're back to where we were before the crisis. Maybe it's the nature of COVID as a crisis. Usually when you have crisis, there's long-standing impact. The 2008 crisis, we didn't get back to pre-2008 levels to 2012. It took 4 years. By September of 2020, equity risk premiums had dropped back down to 4.5%. And it's almost like nothing had happened. Of course, the world had shifted, earnings and cash flows had shifted, but the fear factor seemed to have. You would never be able to catch it with the historical premium. Because with the historical premium, what is the historical premium February 14th? It's 85 years, 95 years of history. That's not moving. And that's the problem with historical premiums. They stay stuck even if the world shifts around. So as I said, until, I've been doing this since 93, from 93 to 2008, I used to do it once every year and use it as my equity risk premium for a mature market over the course of the year. In my defense, somebody said, why don't you do it? It's a mature market. In mature markets, equity risk premiums don't change very much over the course of the year. And until 2008, that was absolutely true. And then 2008 hits, and we get a lesson that this line between developed and emerging markets is a gray one, and that on any given day, a developed market behaves like an emerging market, and equity risk premiums can change. So starting September of 2008, at the start of that crisis, I've been doing this every month. And I do it for me. And here's why. When I updated the Aramco valuation last week, I need an equity risk premium to get started. The equity risk premium I used was the equity risk premium I computed for the S&P 500 at the start of February 2024, which is 4.5%. Any company I value in March, I would be using a different premium. What will it be? I don't know until I get to March 1st. So to me, this becomes the number I anchor my valuation. In a strange way, I am trusting markets to be right in the aggregate, right? But that's not even a question of trust. Basically, this is how I view my mission when I value companies. My job is to value companies given where the market is today. Then if you ask me a question, do you think the market itself is cheap or expensive? That's a different question I can address it. But to do a market neutral valuation, which is what most of your appraisal valuation missions are, you need to be close to the current implied premium. Yes.
So just to validate what you just said, so now the market is at 5,000. Does that mean using the?
Look at that. So 5,000. So first, what will it do to my expected return, up or down?
Your expected return will go down.
Down. Because every week at that bond price happens. So what else has changed?
Equity risk premium.
No, the T-bond rate, right? Started the year at 3.88%. It's now at
4.8%.
The difference is what the equity risk premium is. Stocks have gone up and expected return on stocks has come down, and T-bond rates are pushed up. The equity risk premium is compressing. So it started the year at 4.6, start of February, it's 4.5. And unless we have, and I was going to say start of March would be lower, but if you have 3 more days, like yes, everyone knows what the end of the year is going to look like, right? So this is a number that is dynamic in the sense I have to reflect where I am. But that's the advantage of the number. It's constantly changing. And that makes some people uncomfortable. They want stability. But the world is not a stable place. You got to reflect that in your valuations. So the implied equity risk premium is a forward-looking. Let me talk a little bit about the analyst growth, because people always say, now, aren't you worried that first there is this sense that analysts are biased. They're biased upwards. And that tends to be true when you look at analysts tracking individual companies. They tend to overestimate growth in their company for whatever reason. Maybe it's the bias from having to deal with the company in the future. Maybe it's tunnel vision. But these are not growth rates that come from individual company growth rates, because those I know are biased upwards. They're top-down growth. What are those? There are a few analysts whose job it is to track the earnings for the entire S&P 500. They don't track individual companies. This growth rate comes from their estimates and FactSet tracks it, you can get it online. Their estimates run out 2 years, and then you got to make assumptions beyond that. And I have a history of these forecasted growth rates going back 20 years. So when people said the numbers are too high, they come from analysts, I went and looked at the 20 years. In 11 of the 20 years, the analysts underestimated on it. In 9, they overestimated. In other words, there's no bias. It's pretty much 50-50 something. But they do make mistakes. True. It turns out there's a standard error on the growth rate that. So I tracked out what that standard error is and played it out in terms of what this standard error will be on my equity risk premium, given that the growth rates can be wrong. The standard error in implied equity risk premium is about 0.2%. Remember what it was historic risk premium? 2% plus. The implied premium is 0.2%. So I'm not saying it's perfect, but I'm saying, look, you're going to get a more precise estimate of the implied equity risk of the equity risk premium because of the fact that there are fewer things that you have this range of this on, and that's because it's forward. So this is what the history of that implied equity risk premium looks like for the S&P 500 going back to 1960. And this tells you the story of US equities for the last 54 years. You look at the 1960s, notice it's incredibly stable, 3 to 3.5%. The US equity market was a global equity market, mean reverting economy. You had a recession, you always bounce back. Very stable. Then you get to the 70s, and something seems to be going on, right? Something not good, because the equity risk premium is shooting through the roof. So what do you think happened in the 1970s that caused equity risk premium in the US to go up? Oil crisis in the Middle East. The oil crisis was a precipitating factor. Then you had OPEC. It fed into inflation. You're going to notice inflation keeps entering the conversation, back door, front door, side door. And I think it is the reality is inflation can be corrosive. And high inflation is deadly for equities. I've heard people say, well, people can pay, companies should be able to pass it through. So why should equities be affected? Historically, that's not been the case. The worst decade for US stocks was the 1970s. 1978, the implied equity risk premium in the US was 6.5%. The Dow was at 750. There are only 3 numbers in the Dow. Think about that. Stocks were dead. Yes.
Is that because the idea that they can pass along the inflation to consumers is incorrect, or that they're not able to do it like 100%?
It's because inflation eats away at everything you do as a business, right? You stop investing long term. Why? Because it's not just the level of inflation. It's high inflation goes with uncertainty about inflation. And I think that if you ever lived in a high inflationary economy, you can see very quickly how it starts affecting your decisions. I think people in the US and Europe are not as used. So that's why people are casual. They say, what's the big deal? 4% inflation versus 2%. Now that was the argument at the start of 21. No, and I remember writing a piece saying, I don't know whether inflation, remember the argument then was it's transitory, that was going to go away once you have the supply chain fix. I said, I don't know whether it's permanent or transitory, but act like it's permanent and act now. Because once the genie's out of the bottle, getting it back in is not going to be. In fact, what is the precipitating factor for the market dropping yesterday? Inflation is staying stubborn, 3%, right? We thought we'd conquered it. The genie's out of the bottle, right? It's not going to go easily back to the bottom. And that's, I think, part of the reason companies have trouble. When inflation gets really high, companies stop making any real investments. Every company becomes a financial service company. It becomes much easier to just take the money in, let it out at a higher rate. So that's what you see playing on equity risk. Question.
So how do you fight inflation if you say that the Fed is?
Ultimately, Friedman is right. What is inflation? It's a monetary phenomenon, right? You spend money, eventually, if you spend far more money, and we can talk about why we needed the 2020 and the 2021 big packages where people were mailed out $2,000 a year. But whatever the reason for it is, you can't spend that much money and expect it not to have consequences, right? So in a sense, this is a hangover from 2 years of just crazy, insane amounts of spending. And that, even if we're not going to do it again, it takes a while for it to work its way through the system. Because ultimately our expectations have to change, right? Because once people expect inflation, they demand higher pay. So this is not easily broken. So I would not be surprised if 3%, the news story you saw last week is a news story you will see multiple times over the course of the year. Right? It is the nature of inflation to not go away. So 1978, stocks are dead. Implied equity risk premiums are at all-time highs. And then again, something shifts. In the case of in fact, it's a good point to talk about what happened in the late 70s to break inflation. A guy called Paul Volcker became the chair of the Fed. And over the next 4 years, he broke inflation at a cost. What was the cost? We went into one of the most severe recessions the US has seen since the Great Depression. You broke the demand side. Basically, you broke the expectations of inflation by putting people out of jobs. It's not, and this is why there's no easy fix. It's painful either way. And that inflation break was what led to one of the great bull markets of all time, 1978. You see the equity risk premium drift down. Remember, the essence of a bull market is equity risk premiums are going down. And then they keep going down. By the end of 99, the implied equity risk premium in the US was 2%. It's kind of scary if you think about it. Because if I asked you how many of you would settle for an expected return on stocks of about 6% today, most of you say that's too low. 4% I can make guaranteed. 6% doesn't sound high enough. That's what people collectively were settling for. The T-bond rate was 6.5%. People were settling for 2% above the 6.5%. And they were telling people that they wanted to make 8% equity risk premiums. The definition of a bubble is when you tell me you think you can make 8.5%, you price off a 2.5% premium. Something got to get. And that something is not that that the world will shift to you, it's you have to shift to the world. Then in the next 4 years, you see the dot-com boom busting. For about 4 years, we stayed around a steady state, around 4%. Back to normal. And then 2008 hits. Law again. Since 2008, equity risk premiums have been both higher and more unstable than they've ever been in the US. And that's why I argue this was a breaking point from the old days of mean reverting mature economy. Say, welcome to globalization. We're all connected at the hip. And effectively, that means we're going to have more volatile risk premiums because everybody's problem is everybody else's problem. So that's the historical equity risk premium. And here's another way to present this because the equity risk premiums in the last decade were not bad. They're not like 1999 premiums. They were 4.5. So if you just look at the equity risk premium, you say, what's the big deal? Let me take you back to the start of 2022. The equity risk premium at the start of 2022 was 4.24%, towards the lower end of what it's been historically, but not bad. But it was accompanied by a T-bond rate of 1.5%. Remember, your total expected return is the sum of those two numbers. You are pricing stocks to earn a 5.74% expected return, and that is the lowest number we've had in US market history. US stocks have never been priced to earn that lower return. But if you push people at the start of 2022, what was the reason they gave for still staying in Western equities? The return is low, but what's your alternative? To invest 1.5%. Remember the Tina thing that there is no alternative, that portfolio management, basically stocks look expensive, but where are we going to go? I've sympathy because if you're an investor and you have to invest somewhere and everything is low, you got to accept whatever you can get. Started 2020. And then, of course, in the last 2 years, we've seen an adjustment back to almost a pre-2008 now. They said even with the rise in markets in the last, in the last few months, and the equity risk premiums coming down, we're still around 4.5%. The T-bond rate is still about 4%. Collectively, that's an 8.5% return, which is a quantum jump from the 5.74% we started 2020. For a brief period in 2022, at the end of 2022, this number got as high as 10%. So it's drifted back to 8.5%. The reason I bring this up is, one of the questions I dread getting asked. I tell people, don't ask me what they ask me anyway. Is, do you think the market is overvalued or undervalued? Right? This is a question that CNBC wants to know the answer to every moment of every day. And I've gotten tired of dodging this question. So I said, look, I'm not a market timer. The essence of a market timer. But I can tell you whether I'm comfortable or uncomfortable with the expected return I'm getting, because any question about market valuation is really a question about the equity risk premium, right? So when I ask you, are stocks overvalued today? Don't look at the PE ratio. It's too blunt a metric. You're not going to look at what stocks have done in the last few months. They've done well. You're going to look at the equity risk premium. And right now, as I said, it's 4.4, 4.43%. If you look at the number and say, I'm okay with that, then what have you told me about stocks? They're fairly bad. If you say that number looks too low, you don't even need to finish the rest of the sentence, right? You tell me stocks are too high. And if you say that number looks too high, so every statement about market valuation is really a statement about the equity risk. This is why I said separate the two. If somebody asks me about markets, they're really asking, are you comfortable with the equity risk premium today? If I see 2%, I'm going to say, look, I know that's what the market is pricing and I'm not comfortable. If it's 8%, I'm going to say, this looks too high. It wasn't market. But any question about market valuation can be reframed as a question about equity risk. That's the price of risk in the equity market, the equity risk. Is there a price of risk in the bond market? Absolutely. It's called the default. So what I've done in this graph is actually graphed out the two on the same graph. We don't do this frequently enough. The reason is when we go to market, you go to work on Wall Street, you get siloed. You're an equity person, you're a fixed income person, you're a real estate person, and never the three groups meet together, right? They all live in their silos. Sometimes it's good to see what different markets are delivering as the price of risk. So I focused on one rating, the BAA bond, and track. So basically, there are no particular attachment to BAA. It's investment grade, but I could pick any rating and do this. The black line is basically the default spread in the BAA rating. The red line is my equity risk rate. Remember, price of risk in the equity market, price of risk in the bond market. What do we say drives the price of risk? Fear, right? If people are afraid in one market, are they usually afraid in the other? Usually. Most of the time, equity risk premiums and default spreads move together. When one goes up, the other goes up as well. Why? It's the same people often investing in both markets. But there have been two periods in the last 40 years where the two have moved in opposite directions. And I'll point to the two periods and talk about what happened after those periods, because maybe we need to be watching for that disconnect. The first was in the late 90s. .com boom, the equity risk premium keeps dropping and dropping and dropping, but default spreads stay where they were. End of 99, the equity risk premium is 2%. The default spread on a BAA rated bond was about 2%. You were buying an investment grade bond and getting roughly the same spread as you would get by investing in equities as a class. I mean, we have the benefit of hindsight here, but if I offered you those two as alternate choices, my guess is most of you saying, I'm going to go with the bond. I'm getting the investment grade bond, getting the same spread as equity. I mean, that was an indication the equity market was overpriced relative to the bond market, and you got the .com bust. So that was the first disconnect, late 90s, solved by the equity market kind of collapse. Then you get to this century, and in 2001, of course, in 9/11, we had the terrorist attack, and people worried about, will the US economy go into recession? And Alan Greenspan said, not on my watch, the hubris of central bankers. He said, I am going to keep the US economy out of recession. And he effectively, because rates were, there wasn't much lever, he essentially found ways to act as a lender of last resort without ever saying those words in the bond market. You wouldn't companies go out and borrow money and be able to grow. What does that mean? Well, if you look at what happened during that period, default spreads on bonds decrease. Why? Because you're lending to a company and say, you know what? They get in trouble, somebody is going to bail them out. Default spreads drop. Equity risk premiums stayed where they were. Equities are still viewed as risky. So now you've got the opposite of the late 90s. Equity risk premiums stay high, default spreads are dropping. And if you think about default spreads dropping too much, you're effectively lending money to people at too low a rate. You're not factoring in enough of spread to cover default. When people talk about the many reasons of the 2008 crisis, to me, the connective tissue, the one reason that cuts across all of them, whether it's subprime or real, it's people lending to other people at too low a rate, not factoring. And you can do that for a while until you cannot. And of course, 2008 was the correction for that. And that correction, if you look at it, you saw both the equity risk pop, but take a look at what default spreads. They actually, that was the biggest single year adjustment in default spreads ever. It's almost like people are already, oh my God, let's push up the default spread. Since then, I've kept track of both of these numbers. Why? Because most of the time, as I said, they move together. But I'm looking for disconnects because I know that when you get a disconnect, something bad is waiting for us at the end of that disconnect. And I want to get ahead of the curve if I can find it. So price of risk in the equity market, equity risk move, price of risk in the bond market is the default spread. Is there a price of risk in the real estate market? Anybody here?
What default rate? Mortgage.
No, I might think pure real estate, not developers. Is there something that they use that tells you what they? Anybody what it is? Yeah. Cap rate. It's a cap rate, right? In real estate, it's a capitalization. What is it? Let's say a rental building that makes $1 million in rent income. The way this building is valued, the word value is very light, is you take the million and you divide it by a cap rate. So the cap rate is 8%. So it's a perpetuity. Think of it as a present value of perpetuity. So basically you take the million, divide by 0.08, you come up with 12.5 million. Your cap rate goes to 10%, the amount you would. So as cap rates go up, what you're willing to pay, that look a little, feel a little familiar. That's what equity risk is default spread too, right? The cap rate becomes a proxy for the expected return on real estate. So here's what I did. I decided to bring that into the picture as well, because I wanted to see how that market, because let's face it, in terms of dollar value, the real estate market is much bigger than the bond market and perhaps competes with the equity market in terms of sheer value. There might not be the trading volume on it. So I want to see what that market looks like. So this is a graph. Red line is the equity risk premium, the black is the BA default, so it's previous graph. But the green line is the equity risk premium. Also, the risk premium for real estate. I took the cap rate and subtract out the risk premium. And something very weird seems to be happening, especially if you look before the 1990s. The risk premium on real estate is actually negative. I'm asking you to accept less than the risk-free rate as your long-term return on real estate. And you know what? People did. I don't know whether they still do this in classrooms. When I was first started investing, I was told that every investor should find a way to bring real estate into their portfolio. And what's the argument for bringing real estate into? Then it moved in a different direction than your financial assets. And especially in the 1970s, that was real estate was the only asset class that held up inflation. The argument was if you add real estate to a financial asset portfolio, actually reduce the risk of your overall portfolio because it's a negatively correlated asset. And we sold people on this idea. But something else has clearly changed. If you look at what's happened since, so in the 80s, you can see the risk premium, the 60s, 70s, the 80s, you can see the risk premium in real estate is actually very different. It's negative. And then starting in the 90s, you start to see it move with equity risk premiums and default spreads. So what do you think happened between the 60s and the 90s to explain it? Manish?
Just take a stab at it. Could there be tax changes in investment properties?
No, that would just affect the cash flows, right? It's not making it more or less risky. But remember you mentioned securitization, mortgage-backed securities. Do you remember who the originator of mortgage-backed securities was? Bankers. A guy called Lou Ranieri at Goldman Sachs. It wasn't that long ago, the early 1980s. He came up with mortgage-backed securities with a well-intentioned device. He said, the problem with real estate, it's illiquid. We need to make it more tradable so that people can invest. And then he succeeded beyond his wildest dreams. You securitize real estate. But there's a catch. When you securitize something, it turns out it starts to behave more like a financial asset than a real asset. In the process of making real estate investable, we've destroyed it as a negative correlation asset class. That's huge consequences. For most Americans, if you look at their portfolios, assuming they have wealth, and remember, that's one of the problems in America is 60 to 70% of the population, there is no wealth. So you're constantly struggling because you're income based. But among the people who have wealth, you know what the single biggest asset class in that portfolio? It's a house you own, it's your real estate. And in the old days, your real estate was your anchor, right? Your portfolio went up and down, but today, because of the correlation across markets, you have a year where stocks are down 30%, your bonds are down 15%, you look at your house, it's down 25%. Right? It creates this vacuum of where do I go to diversify? I don't have an answer yet. But now you can see why alternative asset classes take off. Every year I've come up with a new way. Because there is this thirst for, we need something that doesn't move stocks and bonds, but at the same time, we want everything to be securitized. And know whether we can have those two things put together. So when you think about risk premiums, it's not just equities, it's not just bonds. Every risky asset class is a risk premium. And we're thinking about what does that risk premium look like? And how do they vary across that? So I've been pushing this implied equity risk premium now since the early 90s. And it's a very hard sell. People are still attached to historical premiums. They like the stability of that number. And here's one reason they give me why it's okay. So let's say I went to an investment bank and I said, you know what, the implied premium is 4.60%. And the managing director says, we don't use that implied premium, we use a historical premium of stocks versus T-bills. It's amazing what they latch on to whatever number, 8.32%. But then here's his defense. We all use that same risk premium. So the defense seems to be, we don't need to get it right as long as we all use that same risk premium. Let's see if that's true. Let's say you do intrinsic valuation and you all use 8.32% at the start of 2024. What are you going to find with every stock you try? Try again. Value will go down, but that's not undervalued. It'll be overvalued, right? You take the Fangam stocks I valued last week on my blog, you replace the equity risk premium 4.6 with 8.23%. Every one of them is overvalued by 60, 70, 80%. It's not a steady state. These are equity research analysts. They need to put buy recommendations. You know what they do? They compensate for the fact that they use too high a risk premium by pushing up the growth rates, making up stuff. And this is how discounted cash flow valuations lose all sense, is now it becomes an exercise of, I know my discount rate is too high, now I'll make up for it by making my growth rates too high. And where does that process end? So even if you don't buy into my idea of implied premiums, when you do an equity risk premium and you're looking at US stocks, if you see a risk premium that is very different from 4.6%, that person needs to explain that premium first before you look at the valuation, because the rest of the valuation then becomes a joint effect of what this person thinks about the company and what they think about the S&P 500. If you really think the market is overall overvalued by 40%, don't try to disguise that and put it as a sell recommendation on an individual company. Tell me the market is overvalued, but that will define my asset allocation decision. But you need to separate your company valuation from what you think about markets. So as you can see, this equity risk premium thing has been a bit of an obsession for me. So starting again in 2008, I've been writing this annual paper. Paper is just too strong a word. Basically, I pulled together everything I know about equity risk premium. So it's long, it's 125 pages. Start with survey premiums, historical. So everything we talked about in class. So by the end of the paper, by the 20 pages of the end page, I have put out 6 different ways you could estimate equity risk. Historical, you can just take the default spread on a BAA rated bond, multiply by 2. Why 2? Because you look at the history of those 2 numbers I showed you, the average multiple of equity risk default spread by 2. So I get to 20, and I don't want to leave it there because you know what's going to happen. People pick and choose what fits their biases. And they say, okay, why do we use an equity risk? We use an equity risk premium because we're trying to forecast what the market will do in the future. So if I have a good measure of an equity risk premium, and I look at the actual returns you earn on stocks over the next 10 years, what should be true about the correlation? The equity risk premium goes up, I should earn higher returns. In other words, there should be a strong positive correlation. So the way I check out these different approaches is I then, in this case, I've taken 4 different proxies for the implied premium. One is just use the current implied premium, as you can see, is a shifting number. The second is use some kind of an average of an implied premium. Why? Because you want to normalize the numbers, especially if you're like COVID. Third is you use a historical group, which is what 90% of people do. And the fourth is you take the default spread and multiply by 2.02, so it's a default spread based premium. And then I look at how it's correlated with the returns, the actual returns over the next 5 years, and the actual returns over the next 10. So remember, you want high positive correlations. Let's take over the next 5 years. Look across. Well, if this were a contest, implied premium does best in terms of forecasting actual returns. And if this were a contest, who's bringing up the real, what's the worst conceivable way to compute equity risk premiums? Historical premiums, they're perverse. When they give you a high number, you should be using a low number. When they give you a low number, you should be using a high number. But this is the way 90% of the world pushes through the historical premium. My argument for implied premium is not based on theory. It's based on it works better. It does a better job of forecasting what returns to. And isn't that what we're supposed to be building in valuation? Couple of advantages of this implied premium approach. One is that you don't need a historical data. You don't need to look backwards. All you need to get an implied premium for a market is the level of the index today. You should be able to get in any market. The dividends and buybacks, if any, in the most recent period, and expected growth rate, so you can apply it. And that might be the trickiest one. And you don't have to say 5 years. You can do 5, you can do 10. If you have a high growth, young economy, you can say, because the mechanics are the mechanics, and you solve for a required return. So way back in 2007, I tried to compute an implied equity risk premium for the Sensex in the Indian equity index. The level of the index, the only dividend, there were no buybacks at that time for Indian stocks. That's starting to change. The dividend yield on the index was 3.05%. I got stuck on the growth rate because unlike the S&P 500, where you have this top-down analyst projecting growth in earnings, there are no analysts in India projecting growth in earnings for the Sensex. And I had to cheat. And here's what I did. I went, the Sensex luckily is a smaller index. There aren't 500 stocks, actually, or 30 stocks, 40 stocks. I went looking for long-term growth rates on individual stocks. I couldn't find them in India, but if they had ADRs listed in London or New York, I was able to find an expected growth. So I'm putting together this really a half-ass estimate. That half-ass estimate gives me 14% as my growth. As I said, that's the weakest one. The rest is mechanical, right? After year 5, and in this case, I could push it out to year 10. I make the growth rate equal to the risk-free rate, which was 6.76%. That equation looks exactly like the S&P 500 equation. What I get as an expected return, an IRR based on that, is about 11.18%. What does that tell me? In September of 2007, Indian stocks were priced to earn 11.18% in rupee terms. You subtract out the Indian rupee risk-free rate, you get an implied equity risk premium of 4.42%. Basically bypasses, using country ratings and country risk premiums, and look, I'm agnostic. And here's one advantage of doing this is markets like India, there's a very real chance. And India and China have this problem because investors in those countries are kind of forced to invest. They don't have as many options. Your equity risk premium can drop well below that fair premium, and there's nothing you can do. You're going to buy Asian Paints at 50 times earnings, even though you think it's overvalued, because it's not like you can take your money out and buy Facebook instead. That choice is not there. So this actually allows you to say, look, these are markets that are forced to invest inside the market. Their equity risk premiums can get low. Would I ever use this premium? No, because I have choices. But if you're an Indian investor valuing Indian companies, and you can stay only with Indian stocks in your portfolio, this might be an alternative that gives you a more realistic number with which you can value these. One final application at the start of every year. I take all publicly traded companies, I have 48,000 companies. I put them into 2 buckets. A developed market bucket and emerging market bucket, and I get so much crap for which bucket I put countries in. I'm terrified of what I get this week. How dare you put our country into emerging markets? I remember when I started putting half of Southern Europe in emerging markets. They said, you can't do that. I said, you know, whatever I want. I mean, if you're Greece or Italy, what makes you think you're so much better than Indonesia or Chile? You know, why should geography be the driver? And here's why I do it. I divide into two buckets, and then I take these two groups and I do exactly what I did with the S&P 500. I compute an expected return. I have to use a budget because obviously I'm working with a lot of companies. I have to use whatever I can get as growth rate. But here are the key numbers. The implied cost of equity for developed markets in 2004, all done in dollar terms. I can compare apples to apples. 7.28% for developed markets, 10.55% for emerging markets. The difference, 3.27%, was the premium investors were charging for emerging markets in 2000. See, it makes sense. Emerging markets are riskier. Take a look at the difference as you go through the rest of the decade. There's a blip in 2008. But between 2004 and 2012, that premium keeps drifting down and down. And by 2012, it's down to close to zero. At the end of 2000, or the start of 2012, investors were pricing emerging market stocks as about as risky as developed market stocks. And there's a story behind it, right? 2008 meant that developed markets could be emerging markets meant that this was a gray line and we're all part of the global economy. But the truth is emerging markets still are riskier than developed markets. There's more that can go wrong. In the last decade, you've seen a bounce back in that number. But it's not where it was before 2004. Clearly, we're in a world where emerging markets are riskier than developed markets, but the difference between the two is far smaller than it used to be. And I think that's true. Because developed markets are more characteristics now that emerging markets used to have. Central banks you don't trust, governments that are a little unstable, people who do crazy things. And emerging markets sometimes have governments that look more like developed markets used to be. And so I think that gray area is showing up in the risk premiums. But again, with a forward-looking premium, these are the kinds of questions you can ask. Any questions on implied equity risk? Yes.
So, let's say you wanted to value Bovespa. You start with the points that get straight in, but your future capital.
You'd have to get to that. You know the stocks in the Bovespa, you'd have to get their earnings and dividends last year, and you do what I did with the S&P, kind of get a growth rate. Luckily, the Bovespa is a narrow index. There aren't that many companies get the growth rates in each, and what you will use as a growth rate for future cash flows will be a weighted growth rate, because the bigger companies obviously will have much bigger effect. It's a mechanics of actually projecting future earnings and cash flows. So we talked about risk-free rates, we've talked about equity risk premiums. Let's move on to the third and final piece of this puzzle. Now, I'm not going to use the word beta yet, but what we're looking for is measure for relative risk. Let me explain. We know what an average stock should have. That's what an equity risk premium is. When you come to me with a company, the question I'm asking is that above average risk, below average risk? That's what a beta test. And of course, you take a first finance class, you get programmed it, you're told that betas come from regression. You're under regression of returns to the stock against returns in a market index. The slope of the line is the beta. That's the way I was taught betas. That's the way I'm sure you were all taught betas in your foundations course. It's a terrible way to think of betas because it makes beta into a statistical curve. In fact, when you look at the slope of the line and you look at it as a beta, it has three problems. The first is a problem that you should be familiar with right now. It's a statistical problem. You estimate a beta in a regression, it comes with a standard error. It's amazing how we completely forget statistics once we get into finance. Betas are not point estimates, they're a range. And I'll talk about how big that range is. Second, is a beta backward looking or forward looking? It has to be backward looking. Why? Because I need past returns. I can't give you future returns. You're saying, so what? Now, if your company's business mix has changed over those 5 years, imagine running a regression beta for Paramount or for Disney. Very quickly, you can see that you might, even if you trust your beta, it's for a company that used to be, not the company that is today. And third, to the extent that your debt ratio is changing over time, even if your regression beta is right, the beta you should be using should be very different than what you see as a regression. So let me back this up by showing you beta pages from Bloomberg. Okay, for those of you who've not gone to a Bloomberg yet, I think it's the fourth floor, there are 4 Bloomberg numbers. Find your company on the Bloomberg. This is the only thing you actually need Bloomberg for. Everything else you can use regular online sources. Type in the word beta and this page will pop up. It's a regression beta page from Bloomberg. You ask most bankers where they get betas, they don't come from regression, they come from Bloomberg. They look it up. So this is the regression beta page for a company called GoPro. Remember that company? I called it a company that basically made products for oversharing, overactive people. You strapped a camera to your head and you took me on a 3-hour hike as if I was in the least bit interested in watching everything you see for the next 3 hours. You record and put a YouTube video on. The original idea for GoPro is this will be the entertainment hub for people. And my reaction was really depressing, guy. And you sit there rather than go on a hike, you watch somebody else go on a hike for 3 hours. But it had huge soaring expectations, risky company. So I ran a regression beta. I went to Bloomberg, found GoPro, ran a regression. Regression beta 1.604. This is the false precision I warned you about, right? 3rd decimal point nailed it. But remember your statistics. When you run a regression, you get a slope. Right below it, you put the standard error. Let's go down. Standard error beta 0.50. Help me out here. The regression beta is 1.60. The standard error is 0.50. When I ask you what the beta for GoPro is, if you are speaking truthfully from a statistical standpoint, the beta is somewhere between 0.6 and 2.6, right? Plus or minus 2 standard errors. That's what I mean about betas. Is it because the regression was run badly? No, it reflects the fact that there's a lot of noise in this relationship and the regression. So you don't want to trust betas when they have that much noise. You see, then if I get a beta that looks good, can I use it? Be extra careful because there might be a reason why the beta looks good. This is actually a beta page I've saved for about 20 plus years. A beta page I printed off on Nokia in the early part of this century. So I went to Bloomberg had just come in new, banking new Bloomberg, first time around. Nokia, get the best looking beta page I've ever had. Every point is on the line. The standard error is close to 0. If this were a statistics class, I get a gold medal, right? Why does this regression look so much better? It tells me, what do you think is making the regression look? You want to try, David?
The range,
So you're saying Nokia has a smaller range than GoPro? You think that's what it is?
I'm saying the time span that they used to.
This would be true for Nokia no matter what time span I used to. Yes.
Same tax.
Right. We don't talk about this, right? We then betas, regression, returns on the stock against returns in a market index, but somebody's picking the index, right? If you go back and I look at GoPro, what did this is the default. I just printed off the page. Bloomberg picked the SPX, the S&P 5. Why? Because GoPro is a US stock. You're saying, why did they pick SPX? God only knows. They could have picked, the Wilshire 5000 and whatever. They picked the S&P 500. When I asked for a beta for Nokia, Bloomberg picked an index. You know what the index is? Called the HEX. To be quite honest, I didn't even know there was an index called the HEX, which is good since I ran the regression. But you know what the HEX stands for, right? The Helsinki Exchange. See, what's Bloomberg going to Helsinki for? Nokia is a Finnish company. Bloomberg is incredibly parochial about the way they estimate things. So as for a German stock, it will be the DAX, French stock CAC, US stock S&P 500. Nokia against the HEX. I'll confess, I had no idea what else was in the HEX, so I took a look and I wish I had not. So it turned out in 2001, I think Nokia owned Finland. 80% of the HEX came from Nokia. So what is this? A regression of Nokia against?
Nokia.
Yeah, you two moved together. Congratulations. Right? Not to mention the fact that this beta is completely meaningless. Think about what beta measures. Risk added to the marginal investor of the company. So I went looking for the marginal investor. in Nokia, it's easy to find. Just print off the top 17 investors. Top of the list was Barclays for their global index fund. Nokia was a piece of the global index. So if you ask Barclays how risky is Nokia, they're not running a regression against the HEX. They're thinking about risk against the MSCI Global Equity Index. If you run beta regressions right, you should see noise. You should see standard errors. Because the nature of risk is most risk to a diversified investor is risk that you can eliminate from the portfolio. And there's the third problem. And this goes back to David's point about, hey, you picked a period. The Bloomberg default is the last 2 years. But you can change the default. I tell people, look, you give me access to a Bloomberg terminal. You tell me what beta you want for your company. Give me about 30 minutes and I'll deliver a printed page that you can show around. Look, the Bloomberg beta is. And here's why. I can change the index. I can change the starting point and the ending point. I can even change daily to weekly to monthly. I can make a company's beta go from 0.6 to 1.6 based on those choices. And if something happened to a company during a period, something that is company specific, your beta will go up. To illustrate, I estimated the beta or pulled up the beta for GameStop right after they became a meme stock. The stock had gone. I mean, if I asked you whether a stock that goes from 20 to 400 back to 100 again is risky, your reaction is, of course, right? I ran the Bloomberg beta page. The beta is minus 0.62. Think of why. What's happening to GameStop has nothing to do with the market, right? It's going up or down depending on the mood of the meme group on that given day. Betas measure how you move with the market. So not only do you have this problem of noise, you also have this problem of did something happen to my stock during that period, because that's going to destroy it. It's going to be devastating. And finally, as I said, the gaming here is going to be in. We talked about bias, right? You want to come up with a high value for your company, you want a low beta, you want a low value for your company, you want a high beta. And I give you access to a Bloomberg terminal. You're going to find a beta that justifies your biases. This is actually a stock on Bombardier, Canadian aerospace company. And I have two regressions, one against the Canadian index and one against the S&P 500, the ABO. Do I get different betas? Absolutely. 1.704 minus 1.2 versus 1.21. Which one am I going to use? Depending on which side of the bias I'm on. If I think Bombardier is a terrible company, I'm going to use the 1.7 to justify it. If I want to show it's cheap, I'll go with 1.20 and hope that carries me over the finish line. Regression betas are an awful way to think about betas. Or let me take that back. A single regression beta. One slice of history. And we're building an entire castle based on it. So I'm going to argue that maybe we want to leave regression betas behind. But before we do that, there's an even more fundamental question, which is, do you actually want to use betas? I think it was Charlie Munger or Warren Buffett famously said, no, we never use betas. Betas are a terrible way to make. So about 4 years ago, I was in Omaha talking, I don't go to the meeting, but I talked to portfolio managers come to the meeting, two believers. So I said, how many people in this room use betas? Not a single hand went up. And I said, what do you not like about betas? So I'm sure some of you come into the room skeptical, and I am a skeptic too on betas. So I want you to get a sense of what it is about betas that makes you uncomfortable. Because there are two big reasons why people are uncomfortable about betas. I want to see which one it is. Are you comfortable using betas? Yeah. Okay, then fine. Anybody uncomfortable with betas? You go ahead. What makes you uncomfortable with betas?
Just as you just showed, so we can basically data mine it, just like.
But that it could do with any risk management. The data mining is a bias problem, right? So could I not do that with an alternate measure of risk? Probably. So the data mining, I agree, is a problem, and maybe you can play it more easily with betas, but it's going to show up in every risk measure. But to give you some backing, how do I get betas? I use past prices, right? When we started this class, we talked about value versus price. Remember that? And as intrinsic value people, we made a big deal about hey, the price can't be trusted, it's driven by mood and momentum. So the first critique of betas is if you're an intrinsic value person, what the heck are you doing looking at past prices to come up with a measure of risk? Why not look at past earnings or past cash flows? That's close to different. So that's one argument against beta, it's price based. The other argument is a little more subtle. Remember, we started the discussion of risk and return. We talked about how risk is measured through the eyes of the marginal investor in a company. And then we made an assumption for publicly traded stocks that marginal investor is the person. And I admitted then that it's not a perfect assumption. There are companies where this is not going to be true. And it has consequences, right? Because I'm ignoring all that risk that is company specific. So the second argument against betas is, I don't believe this diversified investment. So I was able to extract this with a lot of work from the portfolio manager. I said, yeah, that's fine. Now that I know why you don't like betas, I can give you some alternatives. I said, so you don't believe in, first, let's take the diversified, non-diversified. Let's assume you're okay with the diversified investor argument, but you're not okay with the price-based argument. Instead of using the traditional risk and return models and finding come from prices, tell me what you think about for risk. And I'm going to leave the door open. It could be revenues, it could be earnings. If you say earnings are a much better measure of how a company does than stock price, I can compute an earnings-based risk measure that looks just like a beta. You know, I have this fixation of looking like a beta. At the end of the process, I need a number that's scaled around 1. So if you give me earnings, I'm going to find a way to convert it into above average, below average. You can compute what's called an accounting beta. What's an accounting beta? You run a regression of changes in earnings in a company against changes in earnings for the entire market. Rather than returns on the stock, you're focusing on overall earnings. It's closer to intrinsic value. It comes with a catch. Stock prices I can measure every moment of every day. Earnings get measured how often? Quarterly. At the most 4 times a year. So if I have 5 years of data, I have 20 observations in my regression. So you got to accept the fact that the statistics are going to be a little trickier because of smaller samples. There are also ways in which you can take the cost of debt, which you can argue is observable, right? And say, you know what, equity is typically twice as high. Some Harvard Business School professor claimed that this was great insight. He found 5 companies, he came up with the cost of equity and the cost of debt. He said, typically across these 5 companies, the cost of equity is 2 times the cost of debt. I think this is as close to anecdotal evidence as you can get. But you can extend that principle. It's 2 times the cost of debt. Think of all the trouble you're saving yourself getting away from betas. But then think of how you'd estimate the cost of equity for a company with no debt. Right? I will leave that to you, which is a question I posed to the Harvard Business School professor. She never answered that. So I guess there is no answer. If you go down the other route and say, look, I don't believe investors are diversified now, and you don't like prices, then your argument is you want to focus on all volatility, not just the volatility that's caused by the market. If you want to use price-based measures, then you want to come up with a measure of price-based risk that looks at total risk in the company, not just the risk we cannot diversify. With prices, you get standard deviation. We don't use it when we do betas because only the portion of the standard deviation you cannot diversify when that goes to betas. But if you've got I want to look at total risk, I can do that. I can take the standard deviation in your stock and divide by the average for the market. I'll get a number that looks like a beta. Let's call it relative standard deviation. But now you're not making the diversified investor. Put simply, you tell me your problem with betas. I'll come up with an alternative that reflects how you think about risk and whether you trust prices. I hate this expression, but I'll use it anyway. Don't throw the baby out with the bathwater. Don't stop measuring risk because you don't like betas. No, in fact, in that room, people said they don't do discounted cash flow evaluation. I said, why? Because I don't like betas. And I said, that is a very strange place to begin. Because betas are means to an end for me. It's not my driver for valuation. It's something I need to get a hurdle rate. And if you tell me what your problem is, I can come up with an alternative that looks like a beta that does many of the same things. So as you can see, if you have a diversified investment focus, you're okay with price-based measures, you can use relative standard deviation. Take the standard deviation of each stock, divide by the average market. So your stock standard deviation is 36%. The average standard deviation across all stocks is 40%. 36 divided by 40 is 0.9. Hey, that looks just like a beta. The second is, and this is even easier to do, is let something else stand in for risk. You know, that people say technology stocks are riskier, utilities are safer. You could just say sector-based, these are risky sectors, and come up with cost of equity sector. I can live with that. I can even live with you taking the CAPM and skewing it to include those things. And people do this all the time. They start with the risk-free rate plus beta times risk-free. Then say, you know what, I'll add a small cap rate. I'll add a a premium to reflect the fact that investors are not diversified. Okay. So you got your risk into the picture. If you don't trust prices, then you're kind of stuck because you have to come up with something different. And each of the choices comes with problems. Accounting earnings, one of the problems is once every 3 months. The other is accountants smooth out earnings, not because they're trying to be, they're trying to commit fraud, but that's what accountants do. They spread things out, right? You have a loss, you spread it out over 5 years. The smoothing out of earnings will often skew your risk. You can be a risky company and look safe on an accounting basis. You can even adopt qualitative risk models. Value Line, which is one of the oldest investment services that individual investors could subscribe to starting in the late 60s, has risk. And the way they measure risk is they have 1 through 5, 1 being the safest, 5 being the riskiest. They attach each company a number. And if you give a different cost of equity to each one, I can live with pretty much any way that you bring risk into the process, because at the end of the game, what do I need? I need a cost of equity capital for your company. So if you decide to go that route with something very different than betas, I'm okay with it. So be ready for this, because the pushback you will often get when you do valuation is people latch on to the beta. Even though it's not even on my top 10 list. Last week when on my Mag 7 stocks, this was the big split. I don't like your beta for Facebook. At least pick something which makes a huge difference to the valuation. This isn't the number that's driving the valuation. But be ready. Some people push back. Essentially, don't let them get away with the easy part, which is your model is wrong. Of course it's wrong. Give me what you'd like to use instead, and I'll come up with a way of adapting beta measures to reflect your thoughts. So now I'm kind of ready to bring this discussion back to the start. Now, when I started, I said the way we're taught betas comes from a regression. And then I said the way bankers think about betas, it comes from Bloomberg. The truth is, neither of us is right. Betas don't come from regression, they don't come from Bloomberg, they come from choices you make as a company. And there are 3 choices you make as a company that determine your beta. First is, tell me what you do as a company. What are your products and services? And here's the dividing line. The more discretionary your products and services, the higher your beta would be as a company. You know what I mean by discretionary? People can live without your product, you can defer buying it. You'll have a higher beta. Why? Because in good times, you'll sell a lot, in bad times, you'll sell far less. A luxury retailer should have a lower beta than a discount retailer. And a higher beta than a discount retailer. And a discount retailer should have a higher beta than a grocery store. And within grocery stores, a Whole Foods should have a higher beta than a Kroger's. Pretty simply elasticity of demand, discretionary, not discretionary. So if you pick a company, well, I want you to start thinking about what do they do? What do they sell? Is it discretionary or non-discretionary? One of the reasons I think the Mag 7 stocks held up so well is we discovered that a lot of the stuff they sell has become non-discretionary. Your Netflix costs you almost twice as much as what it cost you 5 years ago. I went to check my bills. I'm almost trapped here. Because I have 5 other people in the family that if I cancel my Netflix, I'd have to go into hiding, witness protection. I don't know where I am. My Amazon Prime this year is $139. It used to be $79. And they keep taking away services. They just told me that if I don't pay $2.99 more per month, I wouldn't be able to watch my Amazon Prime without seeing ads. And guess what? We still didn't lose. In fact, Amazon Prime members went up last year. Netflix didn't have a churn rate that was any different. We're discovering that they're a lot less discretionary, which in the beta terms means they're less risky, lower cost of equity and capital consequence. Second stock, tell me something about your cost structure. The greater the proportionate costs that are fixed costs, the higher your beta. Take a while. In good times, you make lots of money. In bad times, you lose lots of money. It's called operating leverage. Classic example to illustrate how this plays out is in 2020, when the global economy shut down. The hospitality business was mangled, completely destroyed because you basically couldn't travel, couldn't enter. compare hire, excuse me, hire to Airbnb. Think of which of those companies came out less or more unscathed from COVID. Airbnb just laid off 80% of its employees, they go home. Hire tried to maintain the hotels, clean them, because otherwise the rats would take over the rooms. They had the cost of maintaining the infrastructure. So if I compared Airbnb to Hyatt, I'd expect Airbnb to have a lower beta than Hyatt because of their cost structure. And there's a third component, which is tell me how much you borrow. Why does that matter? When you borrow money, you create a fixed cost you did not have until you borrowed the money, interest expenses. In good times, not a big deal. You make higher equity on it. In bad times, a big deal because it makes you lose a lot more money. If you can answer those three questions, I have at least the qualitative foundations for building up to your beta. And I'm going to try to use that to do an end run around regression betas. I don't like regression betas, but I need an alternative. Yes.
So, just curious to know, will the raw material and supply chain issues also affect the unrealized?
Everything will show up somewhere, right? Or take outsourcing. One of the big movements of the outsourcing, the big reason for that was by outsourcing, you reduce your fixed cost. That's effective. So at the first round, it makes us less risky. The only problem is you're outsourcing to China or outsourcing to Vietnam. You reduce your fixed cost at the expense of having a higher equity risk premium because you're now in parts of the world that are much riskier. Everything in life is a trade-off. So when somebody says it's slam dunk, there's no downside to it. It's never true. There's always something you got to trade off. Otherwise, everybody would be doing it. So here's the basic way I think about beta. You come to me with a company and you say, tell me what the beta is. I'm going to start with the beta of the business here. Remember, we talked about discretionary, non-discretionary. If I can get information, see why I have to use the word A. On your cost structure, fixed and variable costs, I will adjust that for whether you're a high fixed cost or a low fixed cost player in that business. And then I'm going to bring in the amount of debt you have into the picture to come up with the revenue. So let's take that operating leverage and financial leverage adjustment and talk about why you see one done all the time, financial leverage adjustment done all the time, but on the other, operating leverage almost never done. I've never seen somebody correct betas for operating leverage. And that includes, and most of the time, when I've had companies, I just take the average beta, unlevered beta for the sector. So let's start with what you would need to adjust for operating leverage. Operating leverage, as I said, is your fixed cost and your variable cost, right? I challenge you to take your company, open up the income statement, and start putting the expenses you see listed into fixed costs and variable costs. So let's go down as normal income statement. You got revenues. Right below that, it says cost of goods sold. You see, probably going to be variable. You throw it in there. Okay. Then you get to SG&A costs. It's variable, depends on the portion of the cost, right? Some of it might be marketing, something. What I'm trying to say is in a typical income statement, you don't have a breakdown of costs into fixed and variable, you have other accounting buckets. Which means you're making a judgment. This is fixed, this is variable. But let's say you were able to do that for your company. To do this adjustment, you'd have to do this for every other company in your sector as well, and God help you. No wonder we throw up our hands. So unless you have an outlier, Southwest in the airline business, much lower fixed cost than the typical airline, Airbnb in the hospitality business, it's probably not even worth the effort. But if you do want to make the adjustment, we know the mechanics are not difficult. You tell me what your fixed cost to variable cost ratio is for every company in sector. Mathematically, I can tell you what the beta adjustment should be. Getting those numbers is a problem. So when people ask you, why don't you correct for operating leverage? So I'm glad to, but can you please go collect it? Put the work back on them because people like to dish out work, right? Correct for this, correct for that. Yeah, I'll do it. No, can you give me a good source for fixing variable costs? Or do it yourself? They'll very quickly change their mind about adjusting for operating leverage. For financial leverage, the adjustment is a lot simpler. Why? Because here you can't hide behind, I don't know what it is, because there is this debt number on your balance sheet. And because we're talking about market value of equity, that is an observable number. So I should be able to observe your debt to equity ratio and clean up for debt. And the way in which people have done it for almost 55 years is a very old correction called the Hamada beta, named after Robert Hamada. He used to teach at the University of Chicago. He came up with this way of cleaning up the beta. It comes with the cost. We'll talk about what that cost is. And basically, he created two versions of betas. One is called an unlevered beta. The unlevered beta comes to the business you're in and your fixed cost variable cost structure. But then he adjusted for the effect of debt by computing a debt to equity ratio. The more you borrow, the higher that ratio is going to be. And then he brought in a 1 minus T. Saying, what's a 1 minus T doing? What is it about debt that might make it a less onerous fixed cost? It's a tax reduction. Government access to coal protector. That's called a commodity beta. It's a very simple, very effective beta, but here's the assumption that let's go. It assumes that all market risk in a company is borne by equity investors. Put differently, the beta of debt is 0. Not that debt is risk-free. People mislead. They assume that risk in debt is company specific. It's not market. I can live with that, but you're going to run into people who make this their big fight, right? Using a commodity beta, the beta of debt is not 0. And we know the beta of debt is not 0, especially as you get to lower rated companies. Because as you know, when you have a AAA, AA, single A rated company, it's probably okay. Because debt moves, but it moves because interest rates move. But when you get to a triple C rated company, the bond starts to behave like equity. The big driver here is what's the equity. So we know the beta of low rated debt is not 0. Again, if you run into this issue, there's a way to fix it. But you know what you need? You need to estimate a beta for debt. Can it be done? Yes. It's a pain in the neck. But in my book, I actually estimate beta for debt by rating class, again, to make my life simple. It's very low until you get to about double B, single B, triple C, and then it starts to rise. 0.3, 0.5, 0.6. Because if I can get a beta for debt, here's what I'll do. And I'll give you the intuition first. Basically, now I'm sharing market risk with the lenders. There's an equity investor that actually makes your equity less risky. So to make your beta of equity lower at really high debt ratios. Is it worth the trouble? I don't think so, because essentially it all evens out in lower cost of capital. But again, if you have a purist, you have to make the adjustment. At least you have the mechanics of doing it. So now I can offer you an alternative regression beta. I call it a bottom-up beta, but it sounds fancy. But here's what it is. You tell me what businesses you operate in. I can estimate a beta. So that was going to be my lab experiment. You started a company. I'll put you in 2 businesses. Pick the fun business. How about cannabis and casinos? Good mix, right? Synergies here, you smoke a lot. You lose all inhibitions and you lose all your wealth and you walk out of it. So then you want to estimate a beta for your company. So here's what I'm going to do. I'm going to go find as many publicly traded cannabis stocks as I can. Are there any? Yeah, no, there are. Actually, most of them are Canadian. There are about 25 cannabis stocks. They're publicly traded. So I look up the betas and I get counted an average regression beta of cannabis. The publicly traded casino companies are 100. I take the average regression beta for 100 casinos. Now, those are regression betas. Regression betas are levered betas. They reflect both the risk you're in and they reflect the leverage that casino companies and cannabis stocks took on. So what I'm going to do is I'm going to take out the effect of that debt because you as a company might have a very different policy. The process is called unlevering. And if you look at the equation, it's just moving things around. So you give me the regression beta, I come up with an unlevered beta. I now have an unlevered beta for cannabis, an unlevered beta for casinos. I come back to you and say, you told me you were in 2 businesses. Can you tell me how much value you get from each business? The first reaction might be, I don't know how much value I get, but I get 80% of my revenues from casinos, 20% from cannabis. I take a weighted average of the 2 unlevered betas. I now have an unlevered beta for your company. Ask your final question. Do you have any debt? If you say no, I'm done, right? That unlevered beta is your levered beta. But if you do have debt, I'll compute a debt to equity ratio and compute a levered beta. Why am I doing all of this? Because I don't like regression betas, right? Where did I get the 25 cannabis stock betas? Regression. So all I've done is replace one regression beta with an average of 25 or an average of 100. So where's the big plus in doing this? What's the advantage of replacing one regression beta?
Pretty risk proposal.
If I had let's say I had 100 stocks just like GoPro. Each of them had a standard error of 0.5. All awful betas, right? I take the 100 betas and average them out. You know what the standard error of the average is going to be? It's going to be what? 0.05, right? 0.5 divided by the square root of 100. It's like magic. You take 100 crappy numbers, you put them in a pot. How the heck do you get a perfect number out of that? Because you average out your mistakes. It's a law of large numbers again, boy. I would never trust a single regression beta. I'm okay with 100. So when you look at bottom-up betas, they're less noise, lower standard error. They're updated. If you entered the cannabis business last week, I can reflect those weights. I can be proactive. You tell me you're going to be in a new business next week. I can bring that in. I control the process. And if you gave me a company like Birkenstock going public and we say estimate the beta for the company, I'm not stuck there saying Bloomberg has no beta for Birkenstock. It did not because it was not traded. All I need to know is the business you're in, and I can get your betas. So bottom-up betas essentially allow you to get past the limits. So when we start next Wednesday, I would start with showing you some bottom-up beta calculations. But we'll talk about cost of debt and cost of capital and when we get started. So I'll see you next one.